Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the program, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects your real estate decisions will be covered here. We're not just going to tell you, hey, interest rates are great, they're low, go ahead and sell your house and buy another. We're going to give you, the real-world advice of what's taking place, the artificial manipulation of interest rates, what that means to you and your real estate, whether you should consider buying based upon what's going on now, or whether you should be making strategic decisions to set yourself up for the future. Joining me on our panel, like every week, is Louis Cammarosano, who used to be the general manager of a major real estate portal. He's a former school teacher, a former attorney. He's also often cited in the media as a real estate industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today, buddy?
I'm doing grand, Ryan. How are you?
I'm doing well. So,
right.
Obviously, last week we discussed a lot about the Fed and how the Fed had basically came out and changed their language and had said that, let's hold up real quick. We were talking a lot about tapering, and the employment numbers came back, and they were obviously not near as good as anybody was anticipating them to be. And now it's interesting because we moved from last week to this week. We had, I think it was initial jobless claims yesterday, which came in. The consensus was 336,000, and the actual was 333. So there wasn't that much of a difference. Mortgage-backed securities did take a little bit of a hit there, but offsetting that headline data was the fact that the prior week was revised upward, and the continuing claims were worse than expected. So, that kind of counteracted that little bit of news. But more interestingly enough, this was yesterday. It was Dallas Fed Fisher was giving an interview on CNBC where he stated that there was improvement in the economy and it is now time to taper. Isn't this interesting how, we have different Fed presidents, some of them saying, hey, economy is doing great, turn the corner, let's start to taper, and the other ones are saying, no, it's not getting better. Is this just like the kind of double talk that basically, do you think this is strategic amongst the Fed, that they have some saying that things are doing well and others that aren't, just so that they can be at a stalemate and not do anything?
That's possible, Ryan, but if you remember, the Dallas Fed president has been a perma hawk. He's the one who mentioned back in June that the Fed needs to get off the monetary cocaine. I think he actually believes that quantitative easing is not good and that it's dangerous. I think he's talking now. I don't think he believes the economy is getting better, but I think he needs to say that in order to support his position, because he has been unsuccessful in convincing his fellow board members on the Fed that they need to stop QE. So I think maybe now he's saying, look, the economy is getting better. You guys satisfied? Let's stop. But it is interesting. It's the number of Fed presidents who speak in between when Bernanke speaks. It seems like they're purposely orchestrating, as you're saying, to give conflicting messages so that people keep guessing and that people don't definitively decide there's going to be a taper, and then you get all the negative reaction, and they don't definitively decide everything is fine and there's not going to be a taper. I think that's kind of part of their plan. And frankly, it's kind of distasteful, and it is manipulative. It's bad enough that they already have control to manipulate the markets almost 100% in terms of interest rates and credit, but then to not be clear about their policy and to have the different board presidents make different statements, competing statements, further complicates the situation.
Yeah, and I mean, if you're just like, let's just say the average consumer out there and you're getting all this information, I mean, it's pretty much impossible to figure out what's going on out there. The Fed has been masterful in the manipulation of interest rates to begin with, but then we have all the different Fed presidents who all have different positions, which is perfectly fine. I'm okay with that. And like you said, I think that, that's more of a posturing thing on his part, like you said, to try to convey his stance without he has to say that the economy is getting better in order for his position to potentially be put into action, which is to taper the quantitative easing, which you and I talked about.
The monetary crack comment didn't go over well, probably.
No, I can't see. I definitely wouldn't think that it would. And you and I have talked ad nauseum that it's just not likely that quantitative easing is going to stop and stop anytime soon. It's interesting. I was reading an article, I believe it was on CNN this morning, that Japan's debt had topped 1 quadrillion yen. And what that basically equates to in U.S. dollars is about $10.5 trillion. They went on to say that while the 1 quadrillion is largely a symbolic level, the eye-popping number was the real challenge for Japan, which was Japan has more debt as a percentage of GDP than any other developed nation, and that Japan's gross public debt was projected to hit 230% of GDP by 2014, after all the years that they've had to stay in these deficits. Which I find, what's really interesting about this article is that I'm trying to really distinguish the difference between Japan and us.
Right, they talk about them as if they're two separate animals. Japan, that's a real horrible situation. Look what they've gotten themselves into. Look at Abe, how much money he's printing. Well, what is the United States doing, Ryan? You're absolutely correct.
Yeah, and so I'm assuming this was probably, and this was actually, let's see here. This was written by a writer in Hong Kong, it looks like. But when we compare it, the U.S. debt right now is probably close to, $17 trillion, something like that?
Well, that's just the debt. That doesn't include the unfunded liabilities of Social Security, Medicare, and the pensions.
Which would put us at even more of an astronomical number.
Like $80-90 trillion.
Right, 80-90 trillion. So really, what we're looking at is almost 10 times what we're looking at over there in Japan. And yet, everybody just seems to not even bat an eye at this, which is amazing to me, because it's like, United States is basically untouchable. We can do no wrong. We can print money forever. And, essentially, Japan doesn't have a way out either. They're going to have to continue the same thing that we're going through now. And they've obviously had decades of stagnation and falling prices. And they think that they can basically, keep pumping money into the infrastructure of their economy and that it's going to turn things around. But then on the other side, they're like, well, how are we going to pay for this? We're going to tax consumption. We're going to raise that up to about 10%. Do you think that that's good for the overall economy? I don't think so.
It really doesn't make a stitch of sense, Ryan. I don't know how anyone in their right mind believes these economic principles that you can have debt to GDP over 200%, that somehow if you have natural disasters, it's good because you get to rebuild. I mean, these are type of almost like voodoo economics. When people actually believe this, they say, well, interest rates are low, we should build our infrastructure. In other words, we're so far into debt, but hey, money's cheap, we should go further into debt. Well,
right.
When are you going to pay it back? Infrastructure doesn't pay for itself. Infrastructure is a cost that you incur to have stuff. You don't make money off of infrastructure. They'll argue, that you get better commerce. That's nonsense. You don't get a return on investment from infrastructure spending. It's an expense. And just because something is cheap, and if your family is way in debt and vacations are on sale, you don't take one. You certainly don't take two because they're really cheap. It just doesn't make any sense. And this is the type of thinking that permeates mainstream economic thought.
Right.
This Keynesian concept that somehow borrowing money and government intervention and central bank intervention is a permanent feature of the economy. It's just how much of it should they do? And, of course, once you take that point of view, that it's a permanent feature and that it's good, you get people saying, the doves like Yellen and Krugman and Bernanke, we should do more. The last thing we want to do is step back from printing money. The last thing we want to do is stop interfering with the markets. We need to interfere more. And it can only end in a disaster. Look at Japan. You're absolutely right. You've got two lost decades, and now instead of trying to rebuild their economy, they've decided one thing can fix it. Print as much money as you can until you get an inflation rate.
Yeah.
On its face, it sounds like if someone came up with that and it didn't have some type of Nobel Prize behind it, you think that sounds very stupid.
Yeah, and it was interesting. I even, when you read down further into the article and actually read the comments, and somebody had actually made the comment that, if the federal income tax rate on all income, and it's, in the United States, well, on all income above the poverty level was raised to 100%, it still would not pay off our debt. So this is a bigger problem than just, raising taxes. And I think this is just a byproduct of big government, right? Government wants to continue to get bigger and bigger and bigger and bigger. So quantitative easing doesn't have a choice but to get bigger and bigger and bigger and bigger, right?
All right. That's what people really don't understand is if the Fed was not buying U.S. Treasuries, the United States could not fund its obligations. The Fed, it used to be, 5, 6, 7, 8 years ago, China funded our obligations. Japan funded our obligations to do deficit spending. Well, now that the deficits have gotten so large, the Fed is actually picking up the tab by printing money out of thin air and allowing the United States government to borrow. So when they say that the Fed says that they want to keep interest rates low, but they don't want to pay for it, meaning they don't want to continue QE, they're going to taper, they're not going to buy as many bonds, well, who is going to buy the bonds to fund the U.S. government? The government has to issue an IOU in order to spend the money, and they do that in the form of issuing treasuries. If the Fed doesn't buy them, who's going to buy them? Remember, we talked about this last week. The reason sovereigns and other people, individuals, investors buy U.S. bonds is because the Fed buys them, and they know they can always sell them back to the Fed. Well, if the Fed isn't buying them, why would you buy them? It undermines the value of the bond if there isn't a liquid market there. And the only way you would buy it is if you get paid a higher percentage interest rate to take on that risk. Well, if the interest rates go higher, the United States can't afford to borrow money. Do you think they'd stop borrowing money? No, they don't want to stop borrowing money. They want to continue at the current pace at least, which is already in a massive deficit, and they still have the obligations on the money they already borrowed, so they still have to pay the interest back. So the United States can't afford higher interest rates. And the only way they can pay for them is if the Fed buys them. And the Fed is saying, we're not going to do QE, we're just going to keep interest rates low. So they want to keep interest rates low without having to pay for it. Right. Can't happen.
And, what's interesting, and I would love to hear the question asked to Bernanke, and any of these other Fed presidents for that matter. Okay, great. You think the economy is doing better. Let's taper. So let's talk about the implications of tapering. That means that interest rates automatically rise. How does the United States plan on paying their debt?
Simple question. Forget what happens to the stock market, the real estate market. How does the U.S. pay its debts? The Treasury can't print the money. The Fed has to.
What would their answer be? They couldn't have an answer for that. Raise taxes? I mean, what's the answer?
Well, first of all, and then whatever solution they come up with spells absolute disaster for the economy.
Right. Yep.
Because if you had to raise taxes to pay for the amount of debt, you're talking about not just taxing millionaires and billionaires, people make over $200,000 a year, an extra 5 or 10%, pay a little more, in the words of the president. You're talking about taxing everyone a massive amount. Well, if the United States economy is based on having consumers spend money that they have, taxing them is going to mean they have less money to spend. Well, what happens to the economy then if it's a spending-driven economy? And everyone's told, I really believe if we get to the point where there is no way for the United States to pay, they'll ask its citizens to pay, and they'll ask them to buy U.S. treasuries.
Right. It'll be basically they're going to force the general public's hands to take retirement plans and to buy government debt, right? Yeah, I
think that's the only untapped pool of money. And this way, at least people can say they got something. They're not being taxed out of existence, that they're becoming the lender and they've got skin in the game, and they're also securing their retirement because they're putting into the so-called secure assets of U.S. Treasuries. I think that's the only buyer that could possibly emerge to pay it. And also, the government can mandate an interest rate that they're able to pay.
Right.
So in other words, if they tell investors you're going to buy U.S. Treasuries, they're not going to say, and we're going to pay you 9-10%. They're going to say, and they're 3% or they're 2%. And
the government and everybody would buy into that fact because the government's guaranteeing this, right?
Correct.
That they're gonna get paid back. You got to get paid back. I mean, it's the government. Come on. Yeah, the government's bankrupt. They don't have any money, but yet it's going to continue because as long as the Fed's here to continue to print money and to add zeros to banks' balance sheets, that everything
exactly.
ignored.
As long as the government controls legal tender laws, which means you have to take the dollar, and they control the issuance of credit and interest rates through the Fed, then people feel comfortable because it's actually mandated by law. And as long as the force of law is in place and people respect that, then they can get away with that.
Yeah, and let's just look at what's taken place over the last year. So, if the Fed says and the government says that, hey, look, let's just take your idea, for instance, and they start taking people's retirement plans and start buying government debt with them and pay people a set interest rate for doing so, and everybody says, oh, over the last year, I mean, I have no reason to not trust them. I mean, look, my property value's gone up. According to Diller, it's gone up about 12%. So I'm gaining equity in my property. Everything's looking on the up and up.
And I'm getting paid interest on my bonds.
Right, I'm getting paid interest on my bonds when there's really
That's a huge way of kicking the can down the road.
Yeah, and that could be a very masterful plan on their behalf, and I'm sure that they've already thought about this, Louis.
They thought about it, but they haven't presented it in the way that it would be a deficit reduction plan. They've talked about it. Oh, if you think about it, they always mention why it's good for you. The mandatory retirement plans are good because people haven't saved, Social Security isn't adequate, 401k plans are now finding aren't adequately funded, the stock market is volatile. So they could present this without even mentioning the debt issue or the crisis that might happen if the U.S. can't pay its obligations because interest rates rise. This solution gives them low interest rates and a ready massive buyer in the form of all the 401k plans. And of course, they can raise taxes along with it too. But the main way of raising that revenue would be through mandatory retirement accounts. I think, didn't you tell me, Ryan, that some countries already do this?
Yeah, there are countries that already do that, and I mean, I haven't looked in depth into government thrift savings plans and stuff like that to see the allocation of funds. But I'm not so sure that a lot of government plans right now are not doing the same thing. You know what I mean? Even our own government, I don't know. I do know that, a lot of those plans, people don't have a clue where their money's going, and that, the people that are in control of handling it, I mean, that might be considered a safer investment right now.
The easiest way to do it, it wouldn't be hard to implement, is you would say 401k plans, a certain percentage of your 401k must be invested in the following securities. And they could be short-term, mid-term, long-term U.S. bonds. And all they would do is pro-rata, look at your 401k plan and shave 20, 30, 40% across the board of whatever else you have, and then go out and your fund manager would be obligated to purchase the U.S. Securities on your behalf. Maybe it could be done very easily. It's not difficult to do. All it takes is a mandate that it has to be done.
A mandate, and then all of a sudden, there's some documentation that gets sent out to every person that they don't read, right? That nobody's going to take the time to sit there and read where their money's going all of a sudden.
Well, it doesn't matter, because if you think about it, a 401k plan is already given to you kind of by the grace of government statute.
Right.
So they can tell you what the terms are. In other words, they're telling you can put this money away and it's tax-free because we say so. Otherwise, it wouldn't be tax-free. Well, they could say it's tax-free
until you retire.
Well, now they can say it's tax-free, but here's another condition: you got to buy U.S. Treasuries.
Yep.
And if you don't want to, take your money out. How many people are going to do that?
Well, I would. I know I would.
I know you would, but most people would not take it out. They wouldn't know what to do with it. They'd have to incur a tax if they did take it out. They might also raise the tax penalty for taking it out after that. In other words, it's 10% now, but they could say, if you take your money out now,
20% penalty, right? Yeah.
Or 30, right?
Right. They could have penalties high enough to where it would deter anybody from doing that.
If I were in charge of government and I wanted it to survive, I wouldn't do this myself, but if I were in a position where I was the person or the president or a policymaker, I would hatch this scheme right away.
Absolutely.
I don't think it causes any. It can be sold very easily.
Yep. Yeah. I mean, and you know, like I said, it would be like nothing really even ever happened. You know what I mean?
Your account balance would still be the same. Now, what might happen is stocks would go down.
Yep.
Because money would be pulled out of the stock market, and they'd say, see, that's the problem with the stock market. It goes down. We're still going to pay the 3% interest.
Right. Yeah, we've got a guaranteed rate. And see, they do, I believe.
And you know what? Maybe you should increase because of the stock market volatility from, you know, the 30-40% threshold. Maybe you should have 50-60%.
Right. Well, I believe that the government does have a fund called like the G Fund or the Guaranteed Fund right now.
Mm-hmm.
And I don't know the specifics of it. I've just heard people tell me about it that are actually in the government that have these plans. And I'm pretty sure that that's probably something close to what you're talking about. You know what I mean?
All you have to do is hire more government workers and make more private people buy the government program. Look, they make you buy health care. Why wouldn't they? I mean, health care is far more controversial. You know, the patient-doctor relationship. There's no such thing as a relationship between you and your broker. I don't think people care about that. So basically, if they come up with a mandatory retirement plan, I don't see people taking to the streets or complaining in any way, shape, or form.
No.
In fact, it reduces the deficit.
Right. And okay, so you know, we just basically come up with an ingenious idea for the government to implement, right? That's probably something that they've thought about doing, and it's just a matter of time because once again, you know, the QE is not going to stop, right?
There is no exit to this. You can scratch your brain and say, well, they stopped QE. What happens?
Yeah, I mean, we just said the number, $80 trillion. I mean, how are you coming back from $80 trillion? You're not. Unless basically you cut government, by 3/4 probably?
Well, there you have real problems cutting government because you start taking people's benefits, entitlements away across the board, you have real problems.
And that's why it would never happen because you can't have those cuts because they would argue that there would be Armageddon out here when people are losing their food stamps or whatever other benefits.
I mean, look at Greece. It's a tiny little country, and look at the problems they had there. If the United States were to have a Greece-style problems, we have far larger cities. We have people that are armed. It would be an impact across the globe.
Yep.
So they can't allow that to happen.
So more or less, as we keep stating, we're basically stuck. There's nothing we can do. And the byproduct of all this is that mortgage interest rates are basically continuing to stay low. I don't see this changing. I think that, you know, obviously we'll have things that set them up and make them go up, but then they'll come back down. But there's nothing. I don't think there's going to be anything that's going to push them into a higher range for an extended period of time. Now, obviously, extended period of time. You can have these little spikes because the Fed either threatens again to taper or they actually taper. The rates will rise, but they'll have to scramble and do something, say something, do something, reinstitute the QE to get them back down. Well, and you know, Luz, the question I get asked all the time is from people like they're in the midst of trying to purchase a home, where they're trying to refinance a home, and they're like, you know, Ryan, I know you follow what's going on with rates. I know you are always watching what the Fed's doing. Hey, did you hear what the Fed said yesterday? What do you think is going to happen with rates? And I'm telling them, okay, well, regardless of what they said yesterday, they don't really mean that because they can't. You know what I mean? They don't. They're just saying it just to say it. So that gets printed out in the media that day. But as you and I discussed, we're talking like long term here. So when I tell people where I think interest rates are headed, I mean, obviously for the short term, they may go down, they may go up. But for the long term, they're going to have to trade within a pretty tight range because of the amount of mortgage-backed securities that the Fed is buying right now.
They have to go higher, but they can't go significantly higher. That's the problem. They should go. If there wasn't for this need for them not to go higher, and if they were subject to normal market dictates, they would go higher. And they will go higher, but like you say, they can't be allowed to go higher.
No.
Because if they're allowed to go higher, I don't care what people say about, that would be a sign of improving economy. No, it would mean that the Fed isn't buying the bonds anymore and they've lost control of interest rates. Well, rates are not going to rise because the economy is firing on all cylinders. If that's the case, that would be great. And that would be the argument that you can pay down the deficit through growth. We're buying growth through QE. We're not growing our way out of it through growth.
Well, to be honest with you, Lewis, I think that they pay quite a bit of attention to these metrics and what's going on in real estate because they know that this is the only thing that's even keeping hope alive is that people's property values are going up and they have a sense of of comfort and happiness that they've got equity in their house that they can then go and borrow more money and spend more money. And not to mention the fact that wasn't Obama who was out in Arizona, was it this past week?
Yeah, he was with Zillow. He had a Q&A and he gave a speech, The Better Bargain.
Right, and certain areas in Arizona have had appreciation of somewhere close to 30%. It's no coincidence that he's out there in Phoenix touting that, property values are going higher and that they plan on shutting Fannie and Freddie down. That's another question I have for you, Lewis. How in the world would you shut down Fannie and Freddie when they're basically the only buyer of mortgages?
I don't know. He said it was kind of self-effacing. He said, now you would think coming from a socialist, Obama, coming from a socialist like me, advocating the abolition of Freddie and Fannie, that would be inconsistent. And he was saying that the free market can handle this better. But at the same time, he also said the Fed should be involved in making sure that the 30-year mortgage, which is the cornerstone of home ownership, remains in place. So maybe he abolishes Fannie and Fed and comes up with something else.
Right.
I don't know how they exit that market either.
They're not going to.
He's not looking to some free market dream where, we eliminate FHA, we eliminate all of the alphabet soups, HARP, HAMP, Fannie, Freddie, and we just go to normal lending by free market.
Right, and the president knows very well that of what's going on here. He's not a dummy. He knows specifically what the Fed's doing. He understands that they're manipulating interest rates. He understands all this stuff.
He knows he's got 3 years left. That basically, if he can avoid the collapse, he can blame it on the mismanagement of the next president.
Right, and what I honestly think is going to happen, so more to my point about where I see interest rates going, how I would say that, how quickly they're going to move up or down. I think the important thing to pay attention to is how fast, how quickly, how much prices rise in certain areas. Because if Case-Shiller is saying that year over year we've had a 12% increase basically nationally, okay? Well, if you look, I think that the Fed realizes that, we might have to slow that down a little bit. That's a bit much. We can't have a 12% increase in 1 year. What we can do to curb that is to allow interest rates to rise up.
Right.
So instead of 3%, we now have 4 to 4.5%, right? If it starts to slow, if values start to retract or go back, or I think they want to try to get it into a moderate range of probably 1, 2, 3% year over year, which is going to basically be impossible for that to happen. Just because they're creating a bubble and it's already happened, it's very hard to slow that down once it starts.
And also, with a bubble, if it bursts, the problems you get from that. But there's a counter side, a flip side to rising home prices. All of a sudden, you're going to get people complaining. Maybe they won't call it inflation, but they'll say home prices are too expensive and I can't make ends meet. I have a part-time job. I have no job. And now everything is more expensive because of what you've done. So they can't satisfy everybody. There's people sitting in their homes want them to go up, but there's also people who want to buy a home that are getting priced out of the market. In many areas, that's already the case. That's happened in the last year or so. At least when the prices were down in Arizona and Phoenix and other parts of the country, on a modest income, you can go buy yourself a house if you can get access to credit. But when the prices rise, then you have a problem. And then you also have the problem, the social problem of, the wealth disparity, because most of the people that own homes are the older generation. The younger generation are not buying homes. They don't have access to the capital. They already have student loan debts, and the prices are expensive. So you have this wealth disparity, which is one of the cornerstones of the president. He doesn't like wealth disparity. But higher home prices create that.
Absolutely.
And, how do you solve that? You have to slow the price of homes to bring them down a bit to make them affordable. So I think your concept is correct, Ryan. Everything they do, they're trying to avoid extremes. They're doing something massively extreme by this QE program. They're trying to keep interest rates within a range. They're trying to they want housing prices to rise, but not too much. It's that whole, someone came up with it 10 years or so ago, the Goldilocks economy. It's the central planning that somehow they can make it not too hot, not too cold, but just right. And they can't.
They can't. And so instead what they do is they have these meetings and they use language that can be very confusing to many. And it's no coincidence
that works, Ryan. Confusing people does work.
It does, because when you have confusion, nobody really knows what to do. So they just say, you know what, I got to trust them because they've obviously know what they're doing.
Exactly. That's exactly right. That you got to trust them because they know better. Look how confusing this is that we've made it. It's like the person who builds a maze and shows you how clever he is because he can get out of it.
Yep.
Well, okay.
Yeah.
Well, that's a maze of your own making that we have no need for.
Right. And the interesting part is that the Fed couldn't lead their way out of this maze if they tried.
No, they've made it too complicated, and it's not. It's almost like Kafka's Castle in the sense that it is so complicated, and it's not just the building of Bernanke or Greenspan. It goes back 100 years. Obama is right in a way when he blames Bush, not because he blames Bush, but he can blame everything that's happened before him with the massive size of government and the massive size of all these programs that all interact with each other, and no one understands how they interact.
Right.
So no one really, all you can do is get in charge of the ship and do a combination of blaming and trying to move money around. But you can't fix anything. And the only real fix you can do is you can throw the whole thing out the window, but that would be disaster for a while.
Right.
But I think eventually it would be better if we got rid of all these programs. Which
we know won't, probably not going to happen. And so let me pose a question then to you, Louis. Let's say that you could afford to buy a house right now, and you're just the average consumer out there. You've got the credit, you've got the employment history, you have all that. You've got, let's say you're in a townhome right now, right? You've got a growing family, and that you're obviously considering moving up, buying a bigger house.
Right.
Knowing what you know now, and you can meet all the lending criteria to get that loan. Would you make that move today to go ahead and buy that bigger home? You would?
Absolutely. And I would base it partially on the concept of investment, but also partially on the concept that a home is an asset, and if you have a home, all this money. The only problem with owning a home is you do have to pay property taxes, and they could get out of hand. So you have to be careful where you pick your home.
Right.
But I think, given that the price of money is cheap, and if I could get that loan, there'd be no reason not to, because you'd lock in your cost of shelter. You'd have a larger home for your family, and whatever happens in the world, you at least have your home, provided you got the right mortgage and you're not overextended. So I'm actually in the process of trying to do that. I'm self-employed, so that makes it a little more difficult. But if it was easy for me to get the loan, then I would buy a house, knowing what I know in this given market, because money, as we've seen, can be confiscated through taxes, can be confiscated through inflation, can be confiscated perhaps through taking your 401k plan, and you lose that element of control. At least the home it goes back to history, the home is your castle. So I think people don't realize that when you and I talk, we're in the real estate business. We favor home ownership.
Yeah,
we just don't favor what the manipulations that go on around the housing market, and we actually don't like these bubbles, because I think it's bad for everyone. I think it's bad for the consumer. I think it's even bad for the real estate professional. Sure, the real estate professional who's selling and getting more money today is happy, but they have to realize that 5 years ago, 4 years ago, 3 years ago, they weren't making any money because of these manipulations, because the bubble burst.
Yep.
So it's not good for anyone other than someone temporarily might make a quick buck. But that's not good for a long-term profession. It's not good for a homeowner who's gone through the gut-wrenching loss of equity, back up to equity, maybe lose it again. That's what I'm against. I'm totally in favor. I love real estate, and I love real estate professionals and the people engaged in the practice, but I don't like what goes on around it.
I agree with you 100%. I love real estate myself. And, people often say, well, Ryan, how come you're not, pumping the real estate market up, doing all these things? I said, because it's important to not, have this false sense of optimism, because of what you're seeing going on around you. I said, you really need to understand the dynamics of the real estate market. I consider myself more of a protector. I would love to protect people's equity that they have in their houses and not to have these major swings up and down, right? And that, to me, is a more sustainable model when you have moderate increases in home prices based upon other sound numbers like, hey, great, we have a growing economy. We have we have a large labor force, more people being hired as full-time employees. Those are numbers that you can hang your hat on, because you can say, okay, this makes sense. Now we have more people that qualify for mortgages. Obviously, more people can now buy houses. So if there's a supply, we can shrink that supply down because there's more people that are willing and able to buy. Not because we have low interest rate environment, which allows for all the investor hawks out there to buy up everything they can get their hands on, the hedge funds. You know what I mean? They've got billions of dollars. This is not a normal market. I'm here to protect, the average consumer that's out here. I want them to understand and be educated that, what's going on with the Fed and the government really does have long-term implications on their family and their housing costs.
Short and long-term.
Short and long-term. And so, the reason why I gave you that example for move-up is because there's some recent reports that say that there could be somewhere close to about 75% of buyers right now are going to be categorized as move-up buyers, as potentially could be making that decision to move from one house to another, maybe get in that house that they plan on staying in for the rest of their life, or at least as long as their kids are growing up and go off to college. So,
Ryan, who are they going to sell those houses to? Because if they're selling, in a sense, starter homes, they're going to have to sell them to millennials who are not really lined up to buy based on their economic circumstances.
Yeah, it's a good question, Louis. I mean, I have a hard time a lot of the time really figuring out, and I try to put my finger on, okay, who is your typical person that's going to buy in this community? Because typically there is some commonalities there. A majority of these people, are they all commuting into D.C. for government jobs? You know what I mean? Are they military-based? From what I've seen, especially, and I'm in a different region, obviously, than you are, but in the D.C. metro area, it is so, infiltrated by military presence here that we always have people moving in and moving out, and they have access to VA loans, which we discussed, I believe it was a week or so ago. And having those VA loans, that really does allow for people to buy homes all over the country, even if they have other mortgages. You know what I mean? So there's a little bit more flexibility with those people. But people that are coming right out of college and taking, a $50,000, $60,000 job, can they buy? They can buy, but how much can they afford? And that price range, there's not that much stuff out there. So, you've really got to have families now that have either paid down on their loan, maybe paid down on their loan for 10 plus years, so they've got some organically built equity, not equity that's from price appreciation, but they've actually paid down their loan. Those are the people that are actually in positions now where they can actually move, and they can make that move up because they've paid down on their loan, put themselves in a position where they've had some price appreciation, and they've organically paid down their loan, that now they can make a little bit of profit off their house and be able to move into the next home. Now, with that, let's just use Case-Shiller. I don't really like that number, but let's just take Case-Shiller, and that there's a 12% increase nationally year over year. So assume there was a home worth $300,000. We're looking at moving up to a home that's $400,000. They would be putting basically down 10%. Say they put down 10%, they get a mortgage of $360,000 on that $400,000 home. But by waiting a year from last year to this year, that home, if it appreciated by 12%, that new home, their home would now be worth about $308,000. The current one they're looking to get rid of, but the home that they're looking to buy at $400,000 would now be worth about $448,000. So their mortgage now, instead of being roughly $360,000, would now be $403,200. So if we then break it down further to say, okay, what were the interest rates last year and this year? Well, last year they were that $360,000 mortgage at a 3.5% interest rate would be $1,616 principal and interest. This year, if you had with a 12% increase, and especially in D.C. Metro, we definitely have had large increases, if not more than that.
Right.
If we had a $403,000 mortgage at 4.5%, it's $2,042 principal and interest. That's a $426 difference in 1 year. Okay.
Now that was on this house, not the house they were going to buy, but the house that appreciated, the original house.
Correct. Well, and we're using
right. But then if you go to buy the new house at the higher rate, that's already appreciated to $448. You're talking about paying probably $800 more a month.
Yeah. Well, what I did was I actually kept the numbers. I was actually basing it off that higher number, but then still putting down a 10% down payment. So the actual mortgage price the loan amount would be $403,000, even though the sales price would have been $448. Does that make sense?
Oh yes, so, I got you. Yeah.
So they're still putting down that same 10%, but it's costing them year over year $426 more with that 12% price appreciation. Now you can't beat yourself up over this, guys. Look, obviously nobody can perfectly time this market, and now. That's why I kind of put two and two together. I'm like, you know what? It is no coincidence now. The Fed sees that prices have risen, and Case-Shiller, which they do look at, by the way, is saying that prices went up 12% last year. They're probably like, whoa. That's way too much. that 12% in 1 year, if we have another year of 12%, that's 25% in 2 years. That's out of control. So
yeah, you'll double in 4 years.
They'll double in 4 years. Exactly. So what can they do? They raise the interest rates by 1%.
Right.
Okay? So now this is what we're looking at. We're now looking at interest rates at 1% higher. Now, this isn't to say, hey, guys, this is going to happen again next year. They're going to go to 5.5% because we really don't know. And we don't have the data for the next year of what's going to take place. To be honest, I think that things are going to start to scale back. I don't think that we're going to have the rapid pace of buying which we've had this year.
No, remember the rapid buying was also, the rapid price appreciation of the buying was also a function of the very low inventory. And I think now that homes are underwater, those homes will start to hit the market, and you've seen a lot of home builders react to the higher prices, and they're building houses on spec. They're also building houses on demand. So the home prices, and also the economy can't support higher home prices. So for all those reasons, you're right. And for the reason they don't want them to rise that high, home prices really shouldn't rise that much in the next year. But you've got the real estate cheerleaders out there. They're predicting 12, 13% this year, another, that's all wishful thinking.
And actually, Louis, it's crazy thinking because it's the worst thing that could possibly happen.
That's why I say careful for what you wish for. If you really think it would be a good thing for real estate prices to rise 15, 20% a year for the next 3 years, it's going to crash, and it'll be worse than last time.
Yeah, and it's no different than if you were investing in a stock, right, Louis, and you saw that, hey, the stock went up by 15%, and then next year it went up by 15%. You're going to say, this can't continue, right? This can't continue.
Actually, stocks can in a way if they're growth. See, the difference between the housing market and a stock can actually grow 20% a year, and their stock price can keep pace. They can continue to grow at that rate for quite some time.
Well,
at some point, they can't.
Well, I agree with you, though. I'm talking about the psychology of how people think about things, though, right? And we continue, like, I know that, if somebody bought a stock for $1 and then it goes to $4, they might say, you know what, let me take my profits because I don't want to get too greedy and all of a sudden it starts pulling back, right?
Right.
Well, with real estate, see, it's almost the same thing because people are, they're watching everybody else. They're like, wow, they just made $50,000 off their house. I think now it's time to take the money off the table. What you don't realize is that on the other side, you're going to go purchase a property at the market value there, right? So,
it's not the same thing, right? This momentum concept works for stocks for a period of time. It doesn't work for real estate. There's a limit to how high prices can go because there's a limit to how much people make. There's a limit to interest rates. It doesn't make any sense. Now, stocks, they can rise, and they can, people do jump on the bandwagon, and you can get left behind. You could see a stock go from 1 to 4 to 4 to 6, $6 to $8, $10, $12, and go to 100. Real estate can't. A house can't go from 300 to 600 to 1.2 to $4 million. There's not enough people making that kind of money, especially if it's originally $300,000 house, to move into a $4 million house. That's basically just a basic home, but now it's a $4 million. It can't happen.
Yeah, it can't happen, and and I think that's why I always tell people, I'm like, they get so caught up in a number that they want for their house, like, hey, I have to make $100,000 on this house. Well, who's in control of that? You know what I mean? There's so many factors that are at play here that when I hear people say that, I'm like, look, okay, what is your goal? Is your goal to make $100,000 off this house, or is your goal to lock yourself into a low fixed rate on another home that you're trying to purchase, right? Like,
got to be the latter, Ryan, because if you want to make $100,000, there's other ways to do it.
Absolutely, 100%.
I'd like to find out what they are, but it's not holding on to a house.
No, but I mean,
it could be. But
I hear people say this all the time, though. I'm not selling unless I get X price. Okay, so let's just assume that.
I'm sorry. Those are people who are not short sale people, but people who have equity.
These are people that have equity. Let's say they know that they've got about, after real estate fees and everything, they're going to net $50,000. They'll say, well, I'm not selling unless I can net $75,000 net, right? Well, that's fine and dandy, but what are you basing your numbers off of? Well, houses went up about 12% last year. If we continue that next year, I'll be at this. And it doesn't work like that. Like I said, and the manipulation of interest rates by the Fed and everything, like I said, this can bring everything to a screeching halt immediately. More importantly, you always try to figure out what your end goal is and not, just the money that you're going to make off of a house. But people get so caught up psychologically in the fact that, they're selling their home, they're attached to it, they feel like they deserve a certain price.
They have to understand value. Just like an employee, I've had employees come to me and say, I need a 20% raise, and I say, well, based on what? And they say, because I need the money. Not based on the value that they're providing, just because they need more money.
Yeah, they feel
you want your house to go up. Oh, so do I.
Right. Yeah.
Who's going to buy it? What's the end game?
Yeah, the end game is that you want to lock yourself in on a 30-year low fixed rate mortgage, on another property, especially if you plan on staying there for 20, 30 years, or your family, even if you have young kids and you're moving into a single family now and you're going to stay there until they graduate and go on to college and you move again. This is the best time to do it because of where we're positioned right now. I mean, obviously, for a lot of people, the equity positions have swung back in your favor now to where you can sell and not take a loss. Okay?
Hey, Brian, I got a question for you. The people who are looking for that $100,000, right? Yep. But let's say it's only $75,000, and you can't bang that into their heads that that's not going to happen. I guess one of the things you can tell them is, though, if you move into the other house with the 30-year fixed mortgage, you're actually over time going to do better than the $25,000 you think you're leaving on the table by only making $75,000.
Oh yeah, I do that all the time. Not to mention, I tell them, we can't control interest rates, right? So I tell people not to necessarily buy. I mean, can you afford the 4.5% that's going right now? If you can afford it, if you can qualify for it, and you can get that, remember, let's just assume that the Fed says all of a sudden that, okay, things aren't moving again. We're going to start buying more mortgage-backed securities all over again, and interest rates go back down to 3.5%. As you can always refinance.
What happens? That's right.
You can always refinance. Don't base your home purchase off of interest rates of where you're predicting them to go. But you can't protect. You are protecting yourself by buying now and getting that 4.5%, right? You can always refinance, but you cannot protect yourself by letting it go to 5.5%. And then you're going to be kicking yourself, saying, "Well, there's no way we can move now because home prices have risen, and now we're at 5.5%, and it's now instead of a $400 additional monthly cost, it's now an $800 or $900 additional monthly cost. So now we can't make that move-up purchase."
And don't the prices would come down if interest rates rise, but they don't come down the day they rise.
Yeah.
So it also takes some time. So now you're going to have to wait another year so that it all works out to your advantage that you can pay the higher rate at the lower priced home. Absolutely. I mean, and it always is a good idea to sell your home when you basically have a market that's, on the rise where interest rates are still relatively low, because especially when you have an inventory shortage, which we do in DC Metro all over the place, that's an ideal situation because you're less likely to maybe pay closing costs. You're probably maybe going to get a bid over what your asking price is. In certain instances, you might just get a cash offer. I mean, it's a great time now only because of all those things. I mean, even investors are saying, because remember, guys, not all investors are smart. They get caught up in the hype just the way everybody else does. Absolutely.
So there's still going to be an investor that says, well, if we make 12% this year, that if that continues, I'll hold this for a year or two. I'll sell that $400,000 house for $550,000. So that happens all day long. But I think that it's a great time now because of the interest rate environment we have, inventory shortage that we have, especially in the DC metro area, and the opportunity for you to be able to get your family into that next home if A, you can qualify, and B, you're comfortable with that new payment to do so. And I think, like I said, I think that it all starts with reaching out to a professional, whether it's me or somebody else, and looking at your options. And when I say looking at them, saying, okay, well, let's say that we didn't net our $100,000, but we only net $60,000. Can we still make the deal work on the other side? Are we still getting what we want? Are we getting the home that we want for our kids and our family? Are we able to have a comfortable mortgage payment? Because those are things that are important, not the dollar amount that you're getting out of your house.
That's a nice to have, that you're giving great advice, Ryan.
Yeah, and I mean, it's like you said, Lewis. I mean, there's tons of ways to make that type of money. Don't look to your home as a means to make money, right?
Or as an ATM to borrow money.
And more times than not, that's exactly what happens. It's like, wow, man, I've got all this appreciation in my house. What do I do with that money? What do I do with it? Well, you don't have to do anything with it,
The only time I'm in favor of it is if somebody's in their advanced years and they have equity in the house and they're realizing that, okay, they're 80 years old, they might live another 10, 20 years, they have enough equity to live off of. Well, at that point, it makes sense to pull the equity if you don't have adequate retirement and you've got equity in your home. But to use it to go out and buy stuff,
Yeah.
In your 30s, 20s, 30s, 40s, 50s, to me doesn't make any sense. I know it's a low interest rate loan, and it's far better than using your credit card. The difference is your credit card, if you don't pay your credit card, well, you get bad credit. You don't pay your home equity back, you lose your house.
Yeah.
So you have to be very careful.
And see, there is a difference too, Louis. Okay, so I will make exceptions because there's some very smart people out there that are able to leverage the bank's money too, as well, right? So if you're going to pull out equity out of your house and you can borrow it at 4.5%, and you can take and use that money for a business or an investment, whatever it may be, and you're going to make 8 to 10 to 15%, and you're leveraging the bank's money, I'm all in favor of that. Okay.
Oh, I'm in favor of that too. I'm not in favor of taking the money out and spending it and not getting a return.
Precisely. I'm not in favor of you taking that money out to go and buy all these things, boats and cars and everything else that basically, at the end of the day, what are you going to get from that? You know what I mean?
They're going to depreciate.
They're going to depreciate. You still got the mortgage. And, what happens is that people, they often say to themselves, let me take out this home equity line of credit to buy this car or boat. And it's amortized over 30 years, but it's due in 15, and they'll say, and I'll just pay that down like a normal auto loan where I'll pay it off in 5 years. How often, Louis, do you think that people hold to that?
They don't.
They don't, because
in fact, they'll go buy another car before they pay.
Because psychologically, and the banks do this intentionally, they send you the bill for the minimum payment, and that's exactly what you make.
Yep.
If you did it and you did it strategically to say, hey, I'm going to make a $500 payment whether they ask me to or not, then that's different. But you have to understand that, the banks obviously are in business to make money. They don't care whether it's putting people in these positions where they struggle. I mean, ultimately, people end up in bankruptcy because they got too much debt and they were only making minimum payments, got in over their head. But if you're making strategic efforts, and all of this stuff can be done, guys. I mean, it's just you have to change the mindset a little bit. But I'm not in favor of taking equity out of your house and making foolish mistakes by buying stuff. That's not a good decision, because you're just putting yourself further in debt with your biggest purchase, your mortgage. And that's something that, probably for most people is probably anywhere from 30 to 50% of your gross income. Realistically,
yep.
That's what it is. So you want to limit that as much as possible, and, you can lock it in. At the 4.5% level that it is right now, guys, I mean, I think that it's just a fantastic opportunity to get in. And if you're able to buy that move-up home, which, some reports are saying somewhere close to 70% of buyers are those move-up buyers where they might have been in a negative equity situation before. They were considering short selling, but now since they've paid their house down and they've gotten appreciation, they have an opportunity to move out. By all means, look at the options. See if you're able to. Now, if you're not able to because of your job situation, because you're a part-time employee now, or whatever other things could be hindering you, whether it's your credit score, which seems to be a big thing now, because if you have a heavy debt load, obviously your credit scores are going to decline, and lenders are very, very picky when it comes to having high credit scores when they lend on mortgages these days. But all these things can be fixed. Remember, but if you don't plan in advance for any of them, and you just show up tomorrow and you say, hey, Ryan, I want to buy a house. I want to buy a house in the next 30 days, and you haven't taken any of these steps ahead of time, nobody's checked your credit, nobody's figured out, what you're currently paying, how much you would pay on the new home, how much of a down payment you have. If nobody sees any of those things, it's not a guarantee that you're going to buy a house in 30 days. It could be 2 or 3 years for all I know. And this is almost like, with financial planners, obviously I'm not a financial planner by any means, but, they sit down and they should be going over these things with you, but a lot of them don't. And especially for your biggest monthly payment and your mortgage, I think it's critical that you're always analyzing and positioning and figuring out where you want to be 5 to 7 to 10 to 15 to 20 years down the road. Do you not agree, Louis?
Ryan, I agree. Unfortunately, most people would agree, but not do it.
Yeah, I agree. I agree with that. And, I brought up the credit situation because we always give credit tips each and every week on our show. And this week, I had read an interesting article on Yahoo of a car buyer who was turned down with a 737 credit score. And the reason for that was that they had a thin credit file. Now, what that basically means is that they didn't have too many revolving lines of credit. They had a bunch of student loans, right? So
they didn't have enough credit cards.
Exactly. Yeah, they didn't have enough credit established. So they had a score, right? They had a great score of 737, but it wasn't enough. They didn't have a healthy mix of credit there. If you had a car, a student loan, a few revolving accounts, and installment loans, that shows more of a well-rounded borrower versus just compared to somebody that got out of college and has 13 student loans, even though they may have had a 737 score, right? Because just having student loans doesn't necessarily mean that you're able to take care of